After my last lesson on retirement income and how 401ks fail, the comments on the YouTube video went wild. Some people said whole life insurance is a scam, annuities are a joke, and they held their 401ks as sacred. And I get it, there's a lot of noise out there. It's hard to discern what to believe. And the truth is that most of us were not taught about how these financial strategies work. So in this lesson, let's dive deeper on 401ks versus whole life insurance and annuities for retirement income. Welcome to the Retirement Income School. I'm Dr. Amanda, and this is your place to learn the lessons that you never got in school on how to protect your wealth and generate guaranteed income so you can retire financially relaxed. Let me give you a little bit of a backstory about why I decided to do another lesson on 401ks versus annuities and whole life insurance. I was in Breckenridge, Colorado, celebrating my honey's birthday, and here we were having a great time, and I picked up my phone to take a picture, and across the screen it just says, "You're a joke." And I was like, oh, wow, that's startling. And it was a comment on YouTube, and the notifications set up on my phone, and I just thought, interesting. And the comments kept rolling in. And as you know, if you are here following me on the Retirement Income School channel, it's a newer channel, so there's not a ton of comments yet. And this video got a lot of comments. And so as I was reading them, I noticed that there were a lot of questions and naysayers. And that helped me know that this is an important topic to dive into in the Retirement Income School. Someone said, whole life is a scam. It's about paying the insurance companies big commissions. And another person said, annuities, what about dying early? This was a really great question, and we will address this in this lesson. They said, what if you unfortunately check out of this earth before expected? And then someone else said, try living without a 401k. Why tie my money up in anything else? And so I noticed there were a lot of questions and concerns, and I wanted to address this by looking at some of the drawbacks of 401ks, specifically for retirement income, so that you can really understand the benefits and drawbacks of whole life, annuities, and 401ks. Every single financial product is going to have different benefits and drawbacks. You're always going to be wanting to educate yourself and choose the right strategy and the right solution that is specific to your situation. And so let's unpack the truth with facts. And before we dive in, I really want to tell you why I teach what I teach in the Retirement Income School. Some of the comments talked about me having a 401k, and someone said, I bet that you invest in a 401k. And I said, I bet I don't, because I've never had a 401k. I've been an entrepreneur most of my life, and in grad school, they don't offer 401ks. So earning my PhD, that was a good portion of my earning years after I was a stay-at-home mom. And then, of course, I worked in high school, but you're not going to have a 401k then. I didn't know a lot about 401ks until I met my husband, who had one his whole life as an employee and contributed. And then we started educating ourselves. He ended up jumping ship from working and jumping into entrepreneurship with me. And so he cashed out his 401k. And in this process, I was learning a lot about retirement strategies, wealth building. My previous business, I was a business coach, and I went from food stamps to six figures in my first year in that business, and then had that business for 6 years. And I taught people about money mindset and how to build their wealth using entrepreneurship. And in that process, of course, I learned a lot about whole life insurance. I got my life insurance license, and I started to understand the drawbacks of how 401ks weren't going to be a good fit for our retirement solutions. And so educating myself, I learned everything that I could. This caused me to know how important financial education is. A lot of wealth building is about your mindset. It's about how you think about building wealth. It's about long-term habits. It's about your goals. It's about what kind of lifestyle you choose to create. It's about thinking about legacy. And so there's a lot that goes into financial planning and retirement planning. And I decided to become a licensed agent originally because I wanted to teach Build Your Wealth workshops with my business coaching clients and my following that I had in that business that I had built up over the years. And because my dad passed away as I was getting more in depth with my retirement income training, I ended up having a lot of clients come my way who were interested in retirement income. And so I jumped ship from the business coaching and went full-time into retirement income planning. So I recently earned my RSSA, which is a registered Social Security analyst. I've got my health insurance license, my life insurance license, specialized training in long-term care insurance, and I'm very close to finishing my RICP, which is a retirement income certified professional. So I'll never stop learning. I believe that financial education is critical to feeling good when you retire, and I highly recommend that you learn everything that you can. Ask a lot of questions. This is your hard-earned money. You don't want to just believe every single person that tells you what to do and not investigate yourself. Sometimes I think this is one of the drawbacks of 401ks is that when you get a job, it's just what everybody does, and you do it without thinking about the benefits and drawbacks for your unique situation. And so that's why I'm here for you, to give you a financial education so that you can make wise decisions. And of course, I'm here for you for a conversation if you want to ask questions and see how what I offer is a good fit. I focus on helping you secure your income floor because I like safe money solutions, because it takes out the guesswork and it allows you to truly be relaxed in retirement. And that's my goal, right? I want to know that I have money sitting there coming in every month for me and I never have to worry about it. That's my goal. That might not be yours, and that's okay. Educate yourself and decide, do I want to be high risk during my retirement? Is it all about leaving a legacy and I care only about growth and I'm going to be very frugal in my retirement era so that I can leave it all to my family? Some people want that. Some people want to spend it all and die with zero, and they want to have fun and they want the most income possible. All of our goals are going to be very different. So pay attention to what yours are. Get to know what retirement means to you, when you want to retire, how you want to retire, and just keep educating yourself. That's why I'm here for you at the Retirement Income School. And if you want to talk to me, just go to retirementincome.school, schedule a Q&A call, and let's have a chat. All right, let's dig into this lesson. Before we dive into 401ks as a savings and portfolio diversification plan, that's not really a complete plan because it's not about retirement income, let's talk about the history of 401ks. So the 401k was created almost by accident in 1978 when Congress added Section 401k to the IRS tax code, allowing employees to defer part of their salary into a retirement account tax-free. Originally, it was intended as a supplement to pensions, and it gained traction in the 1980s when companies realized they could replace costly pension plans with 401ks. So this shifted the burden of retirement savings from employers to employees. And by the 1990s, 401ks became the dominant retirement savings tool in the US, even though they were never designed to be a full retirement income solution. So this is fascinating if you think about it. When you hear 401k, pretty much everyone thinks of it as a retirement income plan or even just a retirement plan. But we forget to ask ourselves, is it a complete plan? So the 401k is awesome in that it encourages savings. So it really creates a disciplined approach to setting money aside for the future. That's great. I think a lot of people would have zero saved if they didn't have that automatic pull from their paycheck going into a 401k. So it does encourage savings and it grows over time. You've got compound interest working in your favor the earlier that you start. And there are often employer matches. So this is like getting free money that boosts your retirement savings automatically. So those are all good things about 401ks. But what most people don't think about in terms of the drawbacks are these next 6 that I'm going to lay out for you. So drawback number 1, a 401k is not an income plan. So you don't know how much to withdraw. The 4% rule is outdated and doesn't fit everyone. And if you don't know what the 4% rule is, I will definitely be doing lessons here on that in the future. For now, you want to think about the 4% rule as a retirement income guideline that says you can withdraw 4% of your retirement savings in the first year of retirement and then adjust that amount for inflation each year, and your money should last 30 years, and should is underscored. An example would be if you were to retire with 1 million, the 4% rule suggests withdrawing 40,000 in year one. In year two, you increase that amount slightly for inflation, and then so on. The limitations to this are huge. It's based on historical market returns, not future guarantees. It assumes a balanced portfolio of stocks and bonds with no major market drops. It doesn't account for healthcare costs, long-term care, or sequence of return risks. And it may fail if you live longer than 30 years or retire during a recession. So that's why the 4% rule is outdated and doesn't fit everyone. If you think about pulling from your 401k by the 4% rule, there's a very good chance that you're going to run out of money. So you have that question, will it last? Because you don't know how long you're going to live or what the markets are going to do. And you've got that sequence of returns risk where early losses can permanently damage your retirement income. And again, that longevity risk where living longer than expected can exhaust your savings. So with the 401k, you're left to guess. That means it's not a plan, it's a gamble. Drawback number 2, market risk. And we did just cover this some in the last drawback, but let's highlight it even further. There's market volatility. So your savings rides the market waves when it's in a 401k. It's not guaranteed and secure. You're riding the waves of market volatility. So bad timing in retirement can really cause a huge problem for longevity and having your income last, because you might be retiring during a downturn, and that would cause you to be subject to the sequence of returns risk. So you've got no protection. There's no guarantees against losses. And you've got uncertain returns. So you can't count on historical averages for future growth. And a lot of people do this. They'll talk about average returns, but that is very different than sequence of returns. And I will definitely be doing a lesson on the difference between those two things so that you can understand how this could affect you, how the market risk can affect your retirement portfolio, and how 401ks are subject to that uncertainty. So your 401k is exposed to the market, which means there's no guarantees, there's no safety net. A lot of it is just hoping. You hope it will work out. And we don't want hope in retirement income when we're ready to relax. We want security and we want to be financially relaxed. Drawback number 3, taxes. So you've got future tax uncertainty. And I really want you to question, will rates be higher when I retire? And most people are predicting that that will be the case, that future tax rates are going to increase. And so if that's the case, when you pull money out of your 401k and it's taxed as income, every withdrawal adds to your tax bracket, and this is going to reduce spendable income because what you withdraw isn't what you actually keep. So I talked about this in the last lesson where we thought about, okay, if you have $1 million heading into retirement and it's in a 401k, let's say you're at an 18% tax bracket, then you're actually going to be withdrawing 180 grand less because that money is going straight to the IRS. And so you really want to be thinking about taxes with your 401k because it's unpredictable because you don't know the future tax rate. So keep in mind that every dollar you take from a traditional 401k is taxable as income. So you're contributing to your traditional 401k tax deferred, and then when you take the money out, now you're going to get taxed on it. And of course, that's a traditional 401k, not a Roth 401k. Drawback number 4 is the fees. So if you look into the fees of your 401k, they can range from 1 to 3% in annual fees. And this is very typical. Most plans charge this much annually. This can add up to over $100,000 in fees over 30 years. And this is a 25% reduction in your final balance. So that's not even talking about taxes reducing your balance. Now we're just talking about the fees. And just to break it down a little bit more, the typical 401k fees include investment fees that can range from 0.1 to 1% annually. And it's important to know that actively managed funds tend to be higher than index funds. You've got plan administration fees, and these might be paid by your employer or are sometimes passed on to you. These are charged by the 401k provider who maintains the plan. Sometimes these show up as quarterly fees or a percentage of your assets. And then advisory fees, if you have a plan that has an investment advisor, and some of these have a human advisor and some have a robo-advisor, and those can range from 0.25 to 1% annually. So just keep that in mind when you're considering the value of your 401k. A 1 to 3% annual fee can eat up hundreds of thousands of dollars over time. And you want to pay attention to these fees early on as you're contributing to your 401k so that you're projecting and understanding how much you're actually going to have when you retire. Drawback number 5 of a 401k is the lack of access to your money. And if you're listening to this on the podcast, instead of watching this on YouTube, I have your capitalized because I think that's something that's really interesting about 401ks is that in a lot of ways it doesn't feel like your money. You are contributing to a plan where the rules can change, where there's volatility, where there's uncertainty. I like to have safe money solutions where, because it's your money, you have control of it and you have contractual guarantees. 401ks don't give you that because there's a lack of access to your money. Your 401k funds are essentially locked away until age 59 and a half. So this could be decades of your money having no flexibility. You've got early withdrawal penalties. So if you take money before 59 and a half, you pay a 10% penalty plus taxes on every dollar. And consider what this does to you when life happens before retirement. You've got things like college expenses and medical bills and opportunities that don't wait for retirement age. And let's say you want to take out a loan from your 401k. You have very limited loan options. Plus, you're going to incur loan fees. So there's a loan origination fee. This is typically a flat fee that's charged when you take out the loan. There's an interest rate. So you repay the loan with interest, usually the prime rate plus 1 to 2%. And then the interest goes back into your 401k, but you're still missing market growth on the borrowed funds. So you've lost the opportunity cost of that money. If you borrow during a market upswing, you may lose out on the growth that could have compounded for retirement. There's also ongoing maintenance fees for loans. So some plans charge annual loan maintenance fees. And then of course you've got loan risk. This is a big one to keep in mind. This actually happened to me and my husband. So if you leave your job, voluntarily or not, the remaining loan balance is often due within 60 to 90 days. Or it's treated as a taxable distribution. So now you're hit with a 10% penalty plus taxes if you're under age 59 and a half, if you don't pay the loan back. So keep this in mind when you're taking loans. If something changes with your job, you're going to need to pay that loan back quickly or you're going to get charged a fee. And I won't go into this yet here in depth, but this is so counter to whole life insurance loans, where in whole life insurance policies, it's your money, it's your cash value. No questions are asked. You're not getting charged fees or taxes when you take out the loans. Yes, they do charge interest, but it's simple interest, and you decide when and how to pay the money back. You can even pass away and never pay the loan back, and the loan will get paid out of your death benefit. And so the flexibility in a whole life insurance loan is vastly different than a 401k loan. Plus, with the 401k, you've got required distributions. So after 73 years old, and that's the current time of this recording in 2025, you must withdraw whether you need the money or not. So, drawback number 5 was lack of access to your money. We could say lack of control to your money, because what if you don't need those required distributions and you don't want to take them at 73? You have to, or you're going to get fined by the IRS. Drawback number 6, no long-term care protection. So if you've watched other videos of mine, you know that in the Smart Life Plan and Safe Flow Income, which is whole life insurance and annuities, you've got long-term care benefits built into the policies. With the 401k, that doesn't exist. So, on average, these are monthly costs for long-term care needs. So let's say home health aid. That could be $4,500 per month that you need. Assisted living can cost $5,000 a month. Nursing home care can be $9,000 a month. Memory care for cognitive decline can be $7,500 a month. And so one medical event could wipe out your entire 401k because there's no built-in safety for that. So you want to make sure that you're considering long-term care protection. If you're only relying on your 401k, it doesn't cover you there other than just you pulling cash straight out of your 401k and you can't leverage it. So that's another drawback to 401ks. Summarizing the 6 drawbacks. Number 1, no income plan. 2, market risk. 3, taxes. 4, fees. 5, lack of access to your money. 6, no long-term care protection. So those are the 6 biggest drawbacks and why you want to be considering diversifying and or transitioning funds from 401ks into other safe guaranteed solutions as you're considering how to create guaranteed solutions for retirement income. So now let's compare the 401k versus whole life insurance and what life insurance can do. Whole life insurance offers tax-free access to your money. So you can take policy loans that provide tax-advantaged liquidity when needed. You can also do withdrawals. So sometimes with clients, when they're ready to start using their policy for retirement income, we'll do a combination of policy loans and withdrawals so that there's no tax burden on that income. And this is also important when you're thinking about the tax efficiency of certain retirement plans causing taxes on your Social Security, creating increases on your Medicare premiums. And so you really do want to be thinking about tax strategy and how the vehicles you're choosing to use from your retirement portfolio are going to impact your taxes. And that's why a lot of people like whole life insurance for this reason. There are a lot of tax advantages. With whole life insurance, you also can grow safely with no market risk. You have guaranteed growth regardless of market conditions. I think one of the best benefits of whole life insurance is that people who use these policies as a buffer asset, as an income floor strategy, they sleep well at night because they're not worried about the market conditions reducing their income floor and reducing their security in retirement. They don't even need to look at it. And when they do, it's grown. And that is a good feeling. Another benefit of whole life insurance is that it provides living benefits for long-term care. So many policies offer accelerated benefits for critical needs, for long-term care needs, and you get to decide how to use that money once you qualify for the long-term care needs. This gives people peace of mind knowing that they're protected and knowing that their retirement dollars are doing more than one job for them and that they have flexibility and access to the money when they need it. Another benefit of whole life insurance is that you can leave a leveraged legacy for your family. So you've got a death benefit that provides tax-free inheritance to your family. This is such a huge benefit. I've seen this happen for my mom when my dad passed. I've seen it happen for clients. I've seen it happen for people when I was learning and hanging out with other insurance agents, clients. They would cry telling me stories about how these legacies had left their family feeling safe and comforted in a time of need when they were grieving and really kept them from being destitute. This is an incredible benefit of whole life insurance, which is, I think, what most people know whole life insurance for is the death benefit. And it does so many more things than that, and yet this is one of the most powerful benefits when you're grieving and when you're thinking about tax strategy. Some people don't need the death benefit, but they use it to pass on a tax-efficient legacy. And now let's look at what annuities can do differently than 401ks for your retirement income strategy. So annuities create guaranteed lifetime income. So what annuities do is they convert your savings into payments that never stop no matter how long you live. To me, that is the gold mine of annuities. They are giving you guaranteed lifetime income no matter how long you live. They give you downside protection. So fixed index annuities protect your principal while still offering growth potential. So if you have a fixed index annuity with an income rider, which is what we're talking about here, you are protected from downturns in the market because you have a zero floor, and you can experience upside gain because your annuity is tied to an index. And so you, again, don't have to worry about that market volatility. You're protected. You're also protected from the sequence of returns risk because you lock in income regardless of market timing or future crashes. So you're never going to have to worry that, oh no, I want to turn my income on my annuity, but it's tanked and I've lost half my money or 25% of my money. That is not possible in an annuity. It's a contractual guarantee, and you will know the minimums when you sign that contract day one. And legacy options, death benefits, or refund options ensure that your family is protected. So this one is addressing the YouTube comment. I'm going to read it because it's a really good question. They say, so guaranteed income for life. What if you unfortunately check out of this earth long before expected? Are there any assets left for legacy purposes? That is, if one is so inclined. I can draw on dividends only and have a beneficiary on my IRA, so that beneficiary will also be able to continue on indefinitely. I have other assets paid off, home, cash, T-bills, and a pension and full Social Security. Buying an insurance policy that is a guaranteed lifetime income makes sense, but I could die much earlier than expected, and where does the next check or residual assets go? And this is a great, important question, and you want to be questioning these types of things when you're thinking about your hard-earned money. What's going to happen to it if I die? What are the tax consequences? What are the sequence of returns risks? What about longevity? What about guarantees? These are really smart questions. And so the answer here to this comment is that when you purchase an annuity, you're buying a contractual guarantee that you will be paid for life when you have a lifetime income annuity. And so let's give an example. If you have, let's just say $100,000 in a deferred annuity. So you sit on it for a couple years, it's growing, it's not lost any money because you've got that downside protection. And then you decide, I want to turn on the income. So you start to get your monthly income. And let's say that you get paid for 1 year, and they calculate that payment based on your age and longevity factors. So if you're 60 years old turning on that annuity, you're going to get paid differently than if you turn that annuity on when you're 75 because of longevity. So, whatever amount you get paid dependent on when you turn it on, in the first year, you're not going to draw down all the cash that you've put in, and let's say you pass away. So whatever money is left when you pass goes to your designated beneficiary or beneficiaries. Or if it was a joint annuity and the income was going to, let's say, a spouse, then that income would just continue going to the spouse. And if you have a joint annuity and you live far beyond the money you ever put in, you're both getting paid for the rest of your life, no matter how long you live. So hopefully that addresses that question. Of course, schedule a call with me to ask more questions, retirementincome.school. Just go to the button at the top of the page and you can chat with me about your particular situation. That was a great question. I like it when people ask questions that we can dig into. So make sure if you're watching and you have questions, leave them in the comments and I will answer them in future lessons. Okay, let's talk about fees because this is important. Annuities have fees and whole life insurance has premiums. So I can already hear it coming. What about the fees? Because you say 401ks have fees. What about annuity fees? And what about whole life insurance? So I wanted to talk to you about that because, that's important to consider. Like I said, 401ks have 1 to 3% annual fees with no guaranteed income, no protection, and no legacy leverage. So 401k fees can feel high because it's sometimes being managed by your company and you don't have a lot of say in the rules of the 401k. An annuity with a lifetime income rider does have a fee. It's typically right now around 1.2% annually. But the difference I want you to think about here is that that fee isn't just going to managing the annuity, it's actually going into fund lifetime income that you can't outlive. So the real benefit of an annuity is longevity protection. So if you put money into an annuity and you start taking money out at 60 and you die at 61, then you didn't benefit as much from the annuity as you could have if you lived to 100. Yet what you're buying is an insurance product that's insuring you in the case that you live longer than expected, or maybe as long as you expect. And so if you're going to live 40 years, 30 years, even 25 years in retirement, annuities are a great fit. If you think you might only live 1 year, it might not be the greatest fit for you. Yet you never know how long you're going to live. And so I love the comfort and security of an annuity with a lifetime income rider. And I also want to highlight that annuities without lifetime income riders don't have those fees at all. You're paying the fee on the lifetime income riders to fund lifetime income that you can't outlive. So that's really the true benefit of an annuity with a lifetime income rider, is that you are purchasing security for life. And that's what that fee is for. And again, keep in mind, if you were to pass after you started taking income from your annuity, remember I said that the money that's left is going to go to your beneficiary. So it's not that you lose the money, it's just that you didn't get the full benefit of getting paid for, 30 to 40 years on your annuity. And for dividend-paying whole life insurance, which is what I use for my Smart Life plans, you are paying a premium. So you're either paying a monthly or an annual. You could also pay quarterly premiums for your whole life insurance policy. And these policies are very much designed for whole life. It's in the name of the product. So the longer you pay, the more you benefit. And so typically when you have a dividend-paying whole life insurance, you're balancing out your premium by the dividend payment. So premiums are typically covered by dividends within about 3 to 5 years. And that's going to be dependent on how your policy is structured. And of course, when we work together, I show you the illustration and you know what to expect. These are just averages here. But what's really cool about that is if you think let's say even in year 5, it takes that long. In year 5, you're paying in an annual premium and you're getting paid a dividend that's the same amount as that annual premium. Well, then you're not paying at all to be covered. And whole life insurance is so leveraged. So let's say you die on day 1 of paying a premium, your beneficiary gets a multiple X of what you've put into that policy. And that keeps growing and growing and growing over time. So that's the beauty of dividend paying whole life insurance, is that you end up having a really powerful policy that you can use as your own banking system. So you become your own bank. And it gives you those tax advantages. It gives you options for income in retirement. It gives you a way to pass on your legacy tax-free. It gives you living benefits. So that is the power of dividend-paying whole life insurance when it's structured properly. And it means that you're not paying for any of those benefits after the first 5 years. I often like to think about dividend-paying whole life insurance like a property that you're purchasing, a real estate investment property where you put money in and your renter's paying down the mortgage. It's not that you have it paid off right away. It's an investment. And whole life insurance is, we don't want to necessarily think about it as an investment. We want to think about it as an asset that is in your portfolio, that is an insurance product, and it's really its own asset class. But it's very similar to a real estate investment strategy where you're putting money in and over time it ends up paying you back because you've paid down the mortgage. Similar to a dividend paying whole life insurance policy, you're paying the premiums, and at some point the premiums are paying for themselves and still giving you all of those long-term benefits. Okay, I want to also address commissions, because one of the comments was about commissions, like, oh, these policies are just paying the insurance companies huge commissions and agents huge commissions. And I think this is so funny because professionals get paid commissions. Yes, advisors, brokers, fund managers, you can think about real estate agents. A lot of people get paid commissions. We get paid for our services. What I like about being an agent is that there's transparency in these commissions. When we work together, you know exactly the commissions that I'm making. There's no hidden fees. Often when I talk to clients and ask them if they know what their fees are in their 401k, they have no idea. Or if they have a financial advisor and I ask them if they know what their management fees are, they have no idea. But then somehow when an insurance agent is promoting life insurance and annuities, it gets turned into a conversation about, well, you're just doing it for the commission. And no way. I think you can already tell if you're here this long in this lesson, you can tell I care about what I do and I have your best interest at heart. I like to be able to sleep at night knowing that my clients are taken care of and that they're sleeping well at night and they're sending me more referrals because everybody feels good and relaxed about their retirement income plan. I don't want to be a person who's scared that my clients feel like they got duped. That is not at all what I'm interested in. And so, it's important for you to be asking yourself questions about financial professionals who you're going to access. I had a great question asked of me in a consult a couple days ago. They were asking, do you work with people who work with financial advisors or do they just work with insurance agents? And it's really a mix, and it's going to be very dependent on what your strategy and goals are. And of course, the financial professional you're working with is going to help you with their strategy based on you aligning your goals with what they offer. And so some people don't need financial advisors. Some people do. Some people want 7 financial professionals on their team. Some people want 1. It's very unique. I've got a wide variety of people who have different types of financial teams. And what you want to be asking in terms of retirement income are these important questions. Does my plan protect me in every market condition? So if you want to first meet that income floor with safe money solutions and know that your bottom line is always met, you want to be asking, does my plan protect me in every market condition? And does my plan create retirement income for life? So those are very important questions when you're thinking about safe money solutions. And those are the ones that I'm focused on. So, I'm much more about making sure you have guaranteed retirement income for life, that your money's protected. We think about how you can pass that on in tax efficient ways, but really my purpose is to give you a financial education so you can see all the options and have true financial security in retirement. And I always want you to be thinking about the options so you have true financial security. This starts with education. You don't want to be blindly heading into retirement wishing and hoping. Instead, you want to have faith and certainty in your retirement income plan. So ask yourself, do I have faith and certainty in my retirement income plan? And if you don't, then it would be really important to talk to me. So recapping what we've talked about in this lesson, think about how you've built wealth and now it's time to protect it. So about 45% of people have 401ks. So maybe you aren't someone who has one. You probably wouldn't have stayed in this lesson this long if you didn't. But if you have a 401k, you want to think about that as the accumulation phase of your life. It's offering you tax-deferred growth and market participation. Now, when you're ready to think about decumulation, you want to be considering annuities and whole life insurance. So annuities give you income guarantees, principal protection, longevity protection, and LTC coverage, while whole life gives you tax-free access, living benefits with that LTC coverage, and legacy creation, a way to become your own bank so that you can have control of and access to your money. So annuities and whole life add what your 401k can't. They can work together, not against each other. So I'm not necessarily anti-401k. I don't have one because I'm not a person who is employed over my life course. And I've shifted my strategy towards annuities and whole life insurance. And that doesn't mean that 401ks are bad. It might mean that you want to start shifting your allocations from your 401ks into annuities and whole life. Perhaps you stop paying above the match. Perhaps you start thinking how you're going to decumulate. Depending on what your age is, you want to start thinking about how to diversify your retirement income portfolio and make sure that you have guaranteed retirement income that's going to last for life and that you have certainty around it so that you can really retire relaxed. I want to highlight last that the Retirement Income School is the education that we all deserved. It's about income planning. and converting savings into reliable retirement paychecks. It's about asset protection and safeguarding what you've built against market crashes. It's about legacy building, creating a meaningful impact for future generations. And it's about fear reduction, so living retirement without constant financial anxiety. So this is really why I created the Retirement Income School, to fill in the missing pieces and help you feel relaxed about your financial reality during retirement. If you're ready to get answers about your retirement income, be sure to book a Q&A call with me by going to retirementincome.school. We will look at your unique situation. I'll ask you questions, get to know you, see if it's a good fit for us to create solutions for you. And then once you're ready to go, we'll implement and monitor along your retirement income journey. And that's a wrap on this lesson. Be sure to subscribe to the channel or the podcast, turn on the notifications so you never miss out. And keep on hanging out with me here in the Retirement Income School, where you'll learn to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.